Hello, this is Jerry. Today I want to give different viewpoints on AI industry. Even the whole world is becoming crazy for AI. With 20 years in financial markets, I've learned one thing. When a big player moves, you pay attention. In October 2025, Softbank quietly sold its entire stake in Nvidia. About 32 million shares, raising roughly 5.8 billion in cash. The sale was revealed a few weeks later in Softbank's earnings. On its own, that's a big trade. But the timing? That's what shook the market. Just days before, Nvidia became the first company in history to hit a $5 trillion market value, after already crossing $4 trillion only 3 months earlier. So today we're going to ask, did Softbank just ring the bell at the top of the AI boom? Or are they simply rotating into the next phase of the AI revolution? Let's start with the facts. In its latest quarterly results, Softbank disclosed that it had sold all of its Nvidia shares in October, cashing out $5.8 billion. On the same slide deck, they showed something else. Net profit more than doubled to around 2.5 trillion yen, roughly 17 billion for the quarter, thanks largely to valuation gains in their OpenAI stake. When the Nvidia sale hit the news wires on November 11th, Nvidia's stock dropped more than 2% that day, and at one point the stock was on track to be down over 10% for the week, as concerns about AI valuations flared up again. So markets clearly saw this as more than just a routine portfolio adjustment. What's Softbank's official line? They say the sale wasn't about Nvidia. It was about freeing up capital for an even bigger AI push. So where is that $5.8 billion going? The answer is into even more aggressive AI bets. First, Softbank is going all in on OpenAI. Multiple reports suggest Softbank is committing around $30 billion to OpenAI in total, after its board approved a final $22.5 billion tranche this year. Second, they're helping bankroll Project Stargate, a proposed $500 billion AI data center build-out in the United States, designed to massively expand compute capacity for advanced models. Third, Softbank has agreed to buy ABB's robotics business for about $5.4 billion, explicitly framing it as part of their physical AI strategy, bringing AI out of the cloud and into robots, factories, and the physical world. So this is important. Softbank is not walking away from AI. They're selling a liquid, listed AI winner, Nvidia, to double down on infrastructure, models, and robotics. From a portfolio management perspective, that's a classic move. Take profit where valuations are stretched. Recycle capital into areas where you believe the risk-reward is now better. So why are commentators talking about an AI bubble? Look at the numbers. Since the launch of ChatGPT in late 2022, Nvidia's share price has risen about 12-fold, helping push the S&P 500 to record highs. In July 2025, Nvidia briefly crossed $4 trillion in value. Then, just 3 months later, it sprinted past $5 trillion. At the same time, generative AI darlings have seen eye-watering jumps in valuation. OpenAI was valued around $157 billion in late 2024 and has been discussed at valuations up to $500 billion within a year. Anthropic jumped from roughly $60 billion to about $170 billion in a similar time frame. This isn't just equity investors getting excited. Big tech and cloud providers are committing hundreds of billions to AI capex. One estimate has Microsoft, Amazon, Google, and Meta collectively planning around $325 billion in AI spending, with a huge chunk flowing straight to Nvidia. But here's the tension. Revenues are growing, yes, but cash burn is even higher in some cases. Yale's analysis of AI economics, for example, points out that OpenAI has pledged about $300 billion of compute spending with Oracle over 5 years, or roughly $60 billion a year. while projected revenue for 2025 is closer to $13 billion. That mismatch, massive capex upfront, uncertain payback, is classic bubble territory if the real-world monetization lags. And it's not just academics. A leading UK tech investor, James Anderson, has publicly warned of disconcerting signs of an AI stock bubble, calling out Nvidia's huge financing ties to OpenAI as reminiscent of dot-com-era vendor financing. Short seller Michael Burry, famous from The Big Short, has reportedly taken large bearish positions against AI winners like Nvidia and Palantir, warning about an AI boom bubble. Even central banks are uneasy. Officials at the Bank of England and the head of the IMF have both flagged the risk that AI-fueled tech prices could be inflated and vulnerable to a sharp correction. Against that backdrop, when a heavyweight like Softbank cashes out of Nvidia right after it becomes the first $5 trillion company, it's easy to interpret that as the smart money thinks this is getting too hot. Here's where nuance matters. If Softbank really believed we were at the end of the AI story, they wouldn't be wiring tens of billions into OpenAI, robotics, and data centers. In fact, Masayoshi Son is still one of the most aggressive AI bulls on the planet. In his 2025 CEO message and conference speeches, he talks openly about making Softbank the world's #1 ASI platform provider. ASI meaning Artificial Superintelligence. At Softbank World 2025, he pushed back against claims that AI was near its limits, saying he expects AGI to arrive much earlier than most people think, and committing around $500 billion to Project Stargate to build the infrastructure for that future. So how do we reconcile this? My read, after 2 decades watching cycles, is this. Softbank isn't bearish on AI. They're cautious on AI equity valuations in the public market, especially for stocks that have already gone vertical. They're basically saying, we still believe in the destination. We're just changing which vehicles we use to get there. So what does all of this tell us about the current moment in markets? First, we are very likely in the exuberance phase of the AI cycle. The technology is real. Productivity gains are real. But expectations, especially for near-term profits, have probably run ahead of what even great businesses can deliver. Second, leadership concentration is extreme. Nvidia has been the single biggest beneficiary of the AI capex wave. When one company's market cap jumps to $5 trillion in under 3 years, after a 10-12x move in the stock, it simply doesn't take much disappointment, a slower capex cycle, a new competitor, a regulatory shock, to knock that down 30-40%. Third, Softbank is showing us a classic playbook used by large, sophisticated investors. Take profits in overextended winners, reallocate into earlier stage, higher risk, but potentially higher return parts of the stack. In this case, models, robotics, and infrastructure. For an individual investor or family office, the lessons are pretty clear. Don't confuse a great company with a great stock at any price. Nvidia is likely to remain central to AI, but that doesn't protect its share price from a 30-50% draw down if expectations reset. Watch what the capital allocators do, not just what they say. Softbank says it's bullish on AI, and its actions confirm that. But how they're bullish is changing, away from listed high flyers toward infrastructure and control positions. Separate the technology cycle from the valuation cycle. AI as a technology probably has a decade or more of expansion ahead. AI as an equity trade might already be in the late innings of its first big wave. From my personal perspective, Softbank's Nvidia exit is both a strategic reallocation into what Masayoshi Son believes will be the foundations of superintelligence and a warning signal that the first phase of the AI trade, The everything Nvidia touches goes up phase may be close to fully priced. If you're positioned heavily in AI today, you don't need to panic. But you do need to be honest about two questions. What has to go right for these valuations to hold, and by when? And if the story takes longer to play out, how much drawdown can you stomach? Because technology revolutions can last decades, but market enthusiasm around them tends to move in violent, uneven cycles. Softbank just reminded us of that with a single trade worth $5.8 billion. This is today's sharing. See you next time.